Today, my guest is Vinney Chopra. He's a returning guest. He's a successful multifamily syndicator. He's raised over $70 million. He's done 26, possibly more syndications. We'll have to ask him. And we're going to talk with him today about the fruits of syndication. He's going to share with us some numbers and some experience on some recent sales. But first, a quick reminder, if you like the show, we would love to hear from you. Please let us know. You can like, share, and subscribe. Also want to remind you, you can leave a comment. And like I said, we love to hear from you. Also, if you'd like to see how handsome our guests are, please check out our YouTube channel, Commercial Real Estate Pro Network. With that, I want to welcome back my guest, Vinney Chopra. Vinney, how you doing?
I'm doing great, Darren. Thank you. So glad to be here with you again.
Oh no, I am excited to see you and get into our talk today. But before we do, if you could take just a minute and share with our listeners a little bit about your background in case they've not heard your story.
Oh, sure. Thank you, Darren. Some of people might know me. I'm Vinney Chopra. I came to this country with $7 in my pocket and sold Bible books and encyclopedias while I was doing my master's in business administration in Atlanta, Georgia, Pulaski, Aiken, South Carolina, all like that. Became a motivational speaker, fundraiser for a long career, kept on buying single family homes. As much money we could save, we would buy. That was my wife and I. We just took pride in that all over the place. But then we found out that single family was not going to get us where we want to be financially and so forth. And the kids were growing up and we wanted to pay for their education, all that stuff, because in Indian culture, you don't really take loans. So we wanted to pay 100, 200,000 each for our children education. But what happened was I became broker in 2004, 15 years back, Darren, and I was going to open up a shop. In other words, like, selling and buying single family homes. And we even started the whole business, got the license, got the stationaries, logos, everything ready to go. Then time came to pay a lease because we wanted to open our own company. We pulled the total plug out of it one night. We said, we're not going to do it. That was the best decision ever we made. We must have lost 10,000 in the process, but that has gained us so much that now we are controlling over $220 million worth of multifamily through investing in multifamily apartments. That's the only niche we have perfected in. And then also we manage them too. So I started 2 acquisition companies and 2 management companies, now educational company, 5 companies.
Wow. Well, that's a lot. I knew a little bit of the story, but every time I talked to you, I learned a little bit more. I didn't realize that you had you were ready to open the doors on your brokerage there. I did not realize that before you made the U-turn into multifamily.
Surely. And, multifamily, that's the other thing I think I would love to chat with your audience is that a lot of people are coaching, go get a duplex, a 4-plex, a 6-plex, 8-plex. I say not to think about that, not to go there, but use the art of syndication. What's the art of syndication is legally get the other people's money, OPM, through legal terms, and then scale up. The key thing is scaling up to 20 units, 50 units, 70 units. I say 70 units because then you can get a property manager in the property and also a technician, HVAC certified, maintenance person also. And that has been the secret to our success. And I'll share a lot more successes as we talk on.
Yeah. Well, I'm loving the fact that we're going to dig deep into kind of the success here. And I just want to remind the listeners too, if you'd like to, be sure to check out, and in the show notes you can see there's, I'm looking at least 6 or 7 episodes that Vinney and I have done in the past where we've covered everything from why multifamily, why syndication, building your team, how to attract other people's money, communicating with investors, underwriting the deal, letter of intent and purchase and sale agreement. And from what we've talked about before, and what I expect us to get into today, is kind of the full circle of that. Because in the past, what we've done is we've kind of covered all of the upfront stuff, and now maybe you want to share with the listeners a little bit about what's happened, or kind of where you're at with a couple of the deals. As far as the sale of those properties.
Totally. Darren, again, I started a company about 12 years back with a partner of mine. We did 14 syndications in that company, and we have sold 12 successfully, completed the cycle as of last year. The two last ones are under contract to sell right now. With my new company, Darren, which I started only 4 years back. See, a lot of your audience might say, oh my gosh, Vinny's got all these wealth or whatever, created over a lot of years. What I would like to mention to your audience is everything that I've done, almost $170 million of acquisitions I've done, has been in the last 4 years. Actually, in 2.5 years alone, because once we got the investors to give their returns every quarter on the quarter, they told more people and more people and more people, their brothers, sisters, daughters, everybody. And I have 130 investors. I have only met with 28 of them,
Wow.
personally, belly to belly, I call it, in sales. But the thing is that once you get those investors to taste your, the returns that you're giving them and share with them, it's a legal way to get them involved through private placement offering, and all that, through the Regulation D exemption, all that, which we covered in your, in the other episodes. I hope your audience will go back again and again. And the best thing is, now we are seeing the fruits of this company. We just sold a property, Darren. We bought for 3.550. That's 3,550,000 in that 156 units property in Texas. 16 units were burned when I bought it. Like they had a grease fire or something happened, matchstick fire. And then the seller sold it very cheaply because they got $1 million from the insurance and they didn't want to rebuild it. So they just took the money and ran, gave me the property, and I put in $1.6 million into it. All right. Now I sold it very successfully for 8.550.
Wow.
8.55. Look at the grain, that value I brought from C class, made it to a B class. And that's the real success, where you're able to give the returns to the investors, their original money back, plus I doubled their money in 4 years.
Wow. I'm sure investors were happy. And the majority of that return comes on the sale. Am I correct in that?
Good point. No, you're so right, Darren. That's why I teach a lot to my students in the academy. You've got to look for jobs. Like at this time, we are looking at 23 emerging markets in USA right now. I gave assignment to my students from 1 week to next week to work hard and get all the economic reports, all the job reports, demographic reports, and everything. And I always believe 1 and 1 is not 2 people, but 1 and 1 is 11. So that's what we did. We got bonkers of information. Some students, it might take them months, to get to these reports. And a lot of my students presented them in a PowerPoint presentation as they are showing it to the investors why they should buy in that emerging market. And that's the key to success in getting other people's money, is to have a PowerPoint, a deck, we call it, credibility deck, so that they can really find out why you are excited to invest in Atlanta or Houston or San Antonio or Orlando or Jacksonville, Louisville, Raleigh-Durham, Greenville, Salt Lake City. I'm just saying some of these markets. There are a lot more than that. But that's the real key, is to really go after job, because in apartments, something is called forced appreciation. It
Right.
does not happen in single family at all. See, single family homes will go up and down because of the neighborhood. If the same square footage of the house is being sold higher because of the people paying higher, then only the single family home will increase in value. In multifamily, it does not matter what the other property down the street is doing. It's what this multifamily or apartment is doing in the net operating income. Now, how do we increase the net operating income? Is by increasing the rents. That's one thing. How can we increase the rent? By having the demand for that multifamily, right? Apartment. If jobs are there, families are moving in, then we can increase the rents if their affordability is there. Secondly, we also collect RUB system, RUBB, RUBS, sorry, ratio utilities bill back system. So we have every property under our portfolio, Monil Premier Communities. We increase the RUBs if the owner, the seller, is collecting only 40%. Sometimes we have found properties they are collecting zero. In this property, it was zero, by the way, the one we just sold. And we charged $50, $70, depending on the size of the apartment. And then people, as the leases expired, we kept on increasing. So the rents went from $350 for a small one bedroom to $450 and $550. Now it's at $695. So
Wow.
by increasing the rents, by renovating, by putting media centers, by giving the the cafes, we make it in our dog parks. We put value into the system. And then we also, in this particular one, property, we built the whole 16 burnt units with sprinkler systems, with all steel appliances, with moldings, right? Moldings in the bedrooms and all that, and granite tops, everything. So the rents went to $895. Oh my gosh, look at that. From $395 to $895. So,
Wow. More than 100%.
and then we manage our assets. That's the other thing, Darren. So that helps a lot because we negotiate. We really do. I have probably spent 7 to 8 million in renovations in just last 3 years, in our communities. It's amazing. I can assure you, I saved at least 18 to 22% because it's amazing how to negotiate with the contractors. It's an art. It really is. And they will take, if it's a win-win situation, if they cannot do the job for you for an 18 to 23%, even from the lowest of the lowest bid, I have trained my managers, my community managers, and I tell them to call. You say you talk to the owner and he's saying, can you give 18% off or up to 20% if it's a pretty big, bid like that. And they come back and they say, oh yeah, okay, let's sign on the deal. See, the contractors have so many people. And if they don't work, they have to pay their salaries, or hourly.
Right. No, there is definitely some value in the negotiation. If you accept the first price, you may be overpaying. I mean, that's
Yes.
unless I've come to, on the flip side of that, recognize if you have somebody and it's a smaller property and you've got somebody that you trust and you know that they're going to, show up on time, get the job done, and
Totally.
knock it out. There may be value in that,
Totally.
but I want to back up here just one second. You were talking about kind of the process there. You talked about the purchase price, the 3.550,
Mhm.
and the 1.6 that you put into the property,
Yes.
and then the rent increase. So I'm assuming two things. I just want to confirm this: is that the cap rate when you bought the property was based on actuals, and did you pay market cap rate when you purchased based on actuals, or can you tell us a little bit about your acquisition?
I would love to. I would love to. See, what happened is that the cap rates, when I bought it in 2014, December 22nd, I closed on it. And because of the property, the front building was burned. I think my broker, listing broker, I only buy from listing brokers, as some of my audience, your audience might know. And the key thing is we have to look at, because the seller got that $1 million or so from the insurance, I'm pretty sure I got it at a discount. I can look at the numbers, but pretty much I can tell you how the market was and everything. So we did buy it at a discount, which mostly all the syndicators should do that,
Sure.
getting the pocket listing and so forth like that. But the other thing was, when I did my underwriting, uh, I did the numbers on 140 units operating, not 156. So that was the other way. I didn't want to put the rents from this new building that I'm going to rebuild, So I didn't want to do that. When I looked at the numbers, Darren, it made sense to buy. And that's where I also would like to stress to the audience, see, you got to just take, leap of faith. You got to do that, because I have seen so many people overanalyze things to the hilt,
Right.
and then they never really can decide to jump into the gun. Uh,
Let me ask you just real quick. You mentioned that you underwrote for the 140 that were the actually operating units,
yes,
right?
yes, yes.
And I think that it's important to recognize here that you truly had an undervalued opportunity based
Yes.
on the seller was ready to be done. They'd got their insurance payment, and
Correct.
they knew that there was. I mean, they're ready to get out. It sounds like, right?
Yeah, I think so. I think
Yeah.
so. I remember driving, actually, when my broker, called me, and I said, "Hey, go ahead and write an LOI on my behalf."
Yeah.
Some brokers will do that. He sent it to me. I easy signed it in the car on my iPhone, sent it back. That was the best moment I remember back now, because had a great payday last week, for one day pay. I mean, after so many hard work, but my investors are so happy. I returned their money plus 107% more, returns in just 4 years. So 26 or 27% return per year that they got.
Got it. So let me ask you this. So the timeline to renovate the project, how long did it take you to get from acquisition to your new?
Beautiful. Beautiful. Darren, very good point. See, I believe whenever we are buying a property, we need to have an executive summary from the due diligence that the team is doing or you are doing yourself, to lay out a plan for the curb appeal. What are we going to do with the, landings and staircases and exteriors and all that? So I started doing that on day one. I'm the kind of guy, I get the contractors' bids. I remember accepting about 15 bids right away within the first 3 months. And then I started getting bid of the big general contractors to rebuild the building. See, that was my main goal, right? So I got, I think, from $991,000 to rebuild that building, 16 units, down to 690. Can you believe it? Or
Oh wow, 30
720,
almost.
740, something
Uh,
like that. And I even asked and did a lot of due diligence on the contractors and talked to the owners who have worked. And I went there, saw their work also. I believe in really big proof, right? What I see is what I get. So then I asked them, hey, my budget does not allow me because insurance is not paying me. I'm paying myself. So they
mhm.
reduced it down again to 690, I think I paid. 690 or 95,000, 16 units, 16 units. So that was a pretty good one. And then not only that, Darren, we also, you have to always look at economies. Where can you do it? We kept the outside shell just like that. And then the inspectors came and we didn't have to even uproot the foundation, anything. Even the lower floors, we were able to save quite a few things and so forth like that. So
You talking about the rebuild or?
rebuild.
Oh, okay, gotcha,
Yeah.
gotcha.
And then renovations. I think I spent the rest of the money in renovations. You're right. Because I like to bring value. So the swimming pool, $22,000. We just got the whole thing resurfaced, new skimmers, new pumps, new everything. The outside, the fencing, another 12,000. So I make decisions quickly to bring value to the residents, because if I want to increase the rent, I better give them more, that they are excited about, right? You
Right.
can't just increase the rent without doing to the asset, giving more value.
So let me ask you. So just to kind of clarify here, we're talking about
Yeah.
what you did to the property that allowed to bring the rents up through the process of the renovation, the repositioning. How long do you think that took
Oh,
overall?
I apologize. You did mention that. I would say that we started increasing rents within 3 months. Within 3 months, because they could see the difference. My flagpoles are up and everything. Curb appeal is better. Then we started working on these units that I just mentioned, the burnt ones, because that was a eyesore right in the front
Right.
of the property. you
Right.
know. And then we started working on the landings, on the staircases. I got the painters come out. First, actually, we had to take care of the property. It was a C property, so we had to repair outside. Then we started into repainting and all the shutters and all the trimmings. I remember one time we had 5 different color schemes painted on one building, on one,
Yeah.
and they did it for free. It's amazing what the Kelly-Moore people will do and other people will do. Then we chose one of the best ones, and I would love to send you the picture of it if you don't mind. If you
Yeah,
want
I'd
to
love to
show
see a
the
before and
audience.
after. Yeah, that'd be great.
Yeah, that'll be amazing. So you're right. I think it took me good 1 year, 1 year.
Okay.
And then for my rebuild of the 16 units took me about year and a half. So we've been doing very well on this asset, and we started. Harvey came, nothing happened to Harvey, in that area and all that. So now we successfully closed on it. Yeah.
Got it. So a year and a half to fully renovate and implement all of your value add strategies. Is that
Yep. Yep.
okay?
That's accurate.
Okay.
I mean, it could
And
be done earlier. It's just that, when you are dealing with a burnt building,
oh yeah, no construction and all that. I was just kind of more curious. Actually, from a standpoint of returns to your investors, I know you pay your investors quarterly on
yes,
the payout.
preferred
So,
rate.
so during that timeline, were you still paying your investors, or was money being pumped back in, or
Oh,
did you
no,
have?
no, 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 no. I'm so glad you said it. Oh my gosh. No, no, no. Actually, I raised almost 900,000.
Okay,
I think so, 8 or 900 from my investors, by the way. I
for the
always,
renovations.
I don't like to take a lot of bridge loans, Darren. And that way, it's good to have bridge loans, but then you have to really get refinancing and this and that. But I just found in this property, I thought, why don't I raise the money, because the property was pretty good. Then I raised the money, and that's when I returned that money back to the investors, now after we sold it. So we didn't give any cash back, or we didn't do any refi. Yeah,
Okay, but just to make it all clear, you raised the money needed for the renovations
exactly.
before, so that you were able to operate and provide returns to your investors
Investors, investors.
all the way through,
All
right?
the way through except for last year, because when we put the property on sale, you know so then we stop paying our investors. They know that, because sometimes repair credits have to be given, or something comes in the due diligence, and we need to have that money available to do those repairs. So
Got it. Rather
that's a
than a
good
cash call
point.
or take a
Yeah,
discount
rather than
on.
a cash call. I've never done a cash call in 12 years. Never, ever.
All right. So on the returns, did they vary, or did you have just kind of a hold steady based on the rents? As the rents went up, were you increasing
Oh yeah,
the return?
returns. What we do is, Darren, we give, like, let's say it's a 8% return. So we give 2% first quarter, 2% of their investment second quarter, 2% third quarter. Then the fourth quarter, we reconcile everything. And if the property made more money for the investors, we give them, like in one of my other property just up the road from this one, the one we sold, we gave our investors 4.26% or 4.76%, sorry, in the
Well,
fourth quarter. So they got, I think, 10.76. That's what it is. Yeah, 10.76, where we promised preferred rate of only 8%. And I'm happy to say about that one too. We're not selling it yet, but I talked to my loan broker, Darren. That property I purchased for 8.7 million. It's worth 13.7 million today.
Wow.
13.75 million in 4 years. That one I bought on November 19th of 2014. And this one I bought a month later. So that was my first property I bought. People can see it. It's Albion. Anybody who wants to buy it from me, I'm not selling yet.
Yeah.
But a lot of people have called me Albion property, in the Houston area, Albion Apartments. That's my property, 192 units. It had $2.6 million already invested by the sellers to renovate it. So
when you bought it, right?
Yeah, got a very good gem in there. And we made $459,000 net income last year. 459,000.
Oh, and that's just in the operating profit.
In the operating side of it, after paying
wow.
all the expenses, after paying the mortgage and the capex, Darren, we realized it. I just had a meeting with my investors. That's why I remember all these things. 395,000 we made net in income for investors and us, and that is in 2017. But last year, December 31st, we did the whole, P&L and everything. 459,000, I think it's coming to my mind, 459 or something.
So in that case there, so you still have the preferred 8% on that one?
Yeah, 8%.
2%, 2%, 2%. What do you remember what the percentage return was in the fourth quarter?
Oh, for that one or this one? Oh, in Albion, we gave 4 point, I think it's 76, something like that. I can look at it. I know if I go to that screen on my laptop, it's going to take me off.
Well, that's fine. That's fine.
Yeah.
No, but I think to remind people how the money gets returned back to the investors. So you do a quarterly a preferred return, and then you reconcile in the fourth quarter.
The fourth quarter.
Right.
I used to do it the other way around, and it was so hard to reconcile every month. I know a lot of people do that. I think it's going berserk, and some people need that monthly. In my investor base, they don't need monthly. So we just do quarterly through bill pay. We have never written a check in our life. We do it all by bill pay. It just printed and goes to them. We have complete history, Darren, of every investor, everything. And then we have Update Capital, where our investors can go in and check everything about their investments on a dashboard. It's marvelous site, and every property they've invested, how much they invested, how much returns they have made as of last quarter, everything is there graphically. They click on the property, then all the pictures of the property, all the financials, their K1s, everything is there,
And are you using a software platform for that, or is that something you guys?
Third party, yeah. It's called Update Capital. I think there are several. These people were really great, and so we started 2 years back with them. Yeah.
Got it. So just to kind of close out this, so we've got 8% is the preferred. You've been running for 4 years. The 3 years you were paying quarterly, plus the fourth quarter you're reconciling and producing more. So in last year, can you tell us when you guys decided to put the property for sale?
Oh yeah. Okay. Now I'm sorry for the audience. I think I might have confused it, because one property we sold, right? 156 units. The one returns I was just giving to you was for Albion property, which is up the road, which is the one from 8.7. It's gone to 13.7 million. That's a separate property. But for the one we sold in the nearby, I don't want to say the name of it, because the owner may not like it, the buyers. But the thing is, that one, we told our investors we'll be selling it in probably, I would say, last July, let's say, July. It takes time.
Right.
See, that's the other thing I want to mention to the audience. It's not that quick, that you just get a listing, you get the brokers and people come in. Some people put bids and all that, but then one bid didn't go through, right, from one investor, buyer group. So we had to then wait and get the next one, and they closed on it. So, you need to look for the strength of the buying party very much before you sign a contract, to sell.
Yeah, no,
So,
and this is exactly what I wanted to get into, because everything you and I have talked about up to this point in these various episodes has been about as a buyer.
yeah,
And all of a sudden we flipped the script here, and now you're the seller.
the seller.
Right. And so now all of that which you were trying to, impress upon the seller, now you are looking for those same qualities in the buyer. Uh,
So
can you tell us a little bit about what you're looking for, and because you
totally.
sound like you had one offer that didn't go
It pan
through.
out.
Yeah.
Yeah, exactly. Darren, the key thing is that, I would highly, highly recommend that when you are selling a property, you definitely want a listing agent. A lot of people contact me right now also. They say, Vinny, do you want to sell this property? This property, we have a group, we have equity raised, all that stuff, right? But then you don't really know professionally what's their buying power, what's their proof of purchase, what's their portfolio look like, all that stuff. By involving a good solid broker in the middle, listing broker we call it, right, is so important to get a good value and close on the property in a very successful way and a professional way. That's what I would say, because that's what happened with this property. It took us some time to sell it. Like I just closed in, January, right? So it's taken us almost, gosh, from the time we thought about selling to now, 7 months. Look at that.
Hmm.
It
Hmm.
should not take that long, but it was like, because we just got the price was right. It was 8.7 million, I think, that other buyer had given us. I went for the higher price, but they couldn't close, right? We found out within 45 days or so, and they went out of it. Then this new buyer gave me money right up front. They were very interested, a hard money or non-refundable money. And also we checked them out better, so that was very, very good. So it's good to see who these parties are who are going to put offers. Don't go for the highest price. That's not going to, work for you.
Yeah, no, I think you hit on a key point, and I think even as buyers, it's important to note what's important for the seller.
Sure.
To recognize that, if you come in with all sorts of fanfare but no substance,
Yeah,
you're only going to frustrate the seller.
totally.
And if you come in but you're underwriting sound, and you've got your money in place,
Yes.
and you've got a commitment, we will close,
Yeah.
and you've got underwriting that backs up your numbers, while they may not be impressed or liking your number per
Totally.
se, like you just experienced. You took the higher number but it didn't happen,
Yeah.
but they came back and ended up being the buyer. Is that,
Yeah.
am I hearing
A
that right?
second party came back. You're right, definitely. So I think it's really good to vet the buyers, which just like us. I mean, when you are performing, I was able to buy and almost syndicate every 2 months. When I was buying, I bought like 10 assets within 2 years, 10 assets. And I
Wow.
bought two in the next 6 months. So 2.5 years, I bought 12 assets, 12 syndications, since 2014 November 19th. So, so,
I
and I didn't buy anything last year, just to be, let your
Right.
audience know, because everybody was just on their horses to, everybody was flying high. Let me say that. Every
Right.
market was hot. The sellers' expectations went way high. Mine did too. But the thing was that you got to really keep it. And I'm seeing so many properties come to me now. I've given to my students so many of them last week before, because there is a shift now in the marketplace. right now with the interest rate going higher by 0.5, also with the adjustment of the cap rates going a little bit higher, the downward pressure is there on the valuations.
Right. No, I think it's definitely the buyer has to assess or I guess hold true to what really works.
Correct.
It sounds like the sellers are accepting the new valuations, or I don't know if they're accepting just yet, but they're being forced to recognize there's been a change in the marketplace.
Surely.
So I'm just curious, and I don't want to get too much or too deep into it, or whatever you're willing to share. But so we talked about in your acquisition on that project, you basically, I don't want to say it was a distress, but you had a seller that was a willing seller, and I think that's always been the key
Yes.
in
Yes.
getting true value. When you made the decision to sell, can you tell us uh, what were the indications, or what led you to the conclusion that it was time to sell, or was this part of your uh, your syndication, and that, like, hey, in 3 to 5 years we're going to be selling the property? And could you
Good
speak a little
point.
bit to
Darren, sure, sure. Always, I mean, now I even do 7-year projections, but we used to always give 5-year projections to our investors. And in the private placement memorandum, PPM, we would list that, we could sell the property between 3 to 7 years, so that you want to cover your bases, if the market takes a downturn or things like that. But once I did the BPO, broker's price opinion, that's very big one, right? Big BPO or BOV, it's called broker's opinion of value, same thing. I found out that this property has gained almost 3 million, right? 3 or 4 million in equity. I said, oh my gosh, price has gone up. Even if I put my capex money in there, still it's a pretty hefty amount. So that's when I brought it to my investors, and they agreed with me. They said, Vinny, yeah, let's sell. So we take about 70% approval from our investors to do major things, which is like selling of the property or refinancing the property, things like that, right? So that's when we made a decision, and my investors couldn't be happier because I returned their, thousands of dollars and millions actually. And then, they saw their pocketbook. They said, Vinny, your investment has done so well. I just had dinner with one family locally, and they have invested in my 9 or 10 deals, and their children have invested and all that. So they were very happy.
No, that's great. That's great. So basically, the selling signals where you got a broker a
Value.
price opinion
We
there,
broker opinion of value, sure.
and then kind of a presentation to your investors, and it was agreed. Let's pull the trigger and put it
Yeah.
up for sale.
Yep.
And then just to again follow through on this. So then, once that decision's made, you explain to them that distribution will stop until
Yes.
sale, so that if there's any reconciliation or any funds needed to do this or that to make
Totally,
the sale.
totally. Sure, you're so right, Darren. And the other part now is you've got BOV from one company, one broker, second broker, third broker, fourth broker. So I would suggest to your audience, try to talk to 4 different brokerage houses, you know, and then see how they look at your asset. What effort are they making to give you the BOV? Because see, when I have purchased property off market, I got that property from one broker. Then another broker gave me a week later. Another broker gave me the same address 10 days later, because nobody has a listing. See, they are trying to get the listing. So it's so important that we also go with a broker who is a worker, doer, who has a good marketing plan, who has a big email list and all that, right? Who's going to work hard for you.
Right, right. No, that's good stuff.
Yeah.
Vinny, I want to wrap up this portion of the conversation. I've got a new segment I wanted to ask you, but is there anything on the selling of the property that we didn't cover that you feel was important?
I would definitely hit the management side of it, if I may.
Yeah.
See, I think a lot of gurus, a lot of coaches talk about let's buy a deal, put an LOI, put a this. I think the biggest thing is getting the money through syndication, then you have to perform on those projections. That is the missing link in everybody's, and that's what I'm planning to do, to really teach now the students how to take over the property, because we manage ourselves the asset, and that is the real deal in these acquisitions and everything. If we don't manage it right, if we give it to third party and they don't manage it right, then investors will not get their returns. So a lot of hard work goes on after the sale is closed. We work hard before the sale, but when you take over the asset, that's when the real deal starts.
Right. In order to have that ultimate payday on the sale, you've got to do all that heavy lifting,
Yep.
the day to day to get those numbers up that will reflect the valuation, which
Exactly, exactly. That
truly.
is the real deal. And then you feel so good, especially in our company, we manage our assets. So we get paid 4% of the rental, total gross rental every month also, to manage the managers, it's called. Yeah. You
Right.
know, and
Right.
that way, because I'm on the loan on millions of dollars, I wanted to control my assets. I could not leave in the hands of third party. But a lot of people do that because they can do, what.
Sure. No, I think you definitely have a unique position, and I would totally concur if you have the unit count and it's all proximate in location and stuff that
Totally,
considering operating and
totally,
managing yourself makes complete sense. That's great.
totally, totally.
Hey, I've got a commitment to myself and the listeners this year, starting in 2019, that I've been asking all of my guests about risk management. As you know, and I've talked to you a little bit, is by day I'm an insurance broker, and I'm trying
Yeah,
to get just kind of a kind of a risk question answered by my guests, and I want to just ask you this question, and I want you to also. It doesn't have to be an insurance related
sure.
answer, but with regards to risk and risk management from a risk management strategy, there's basically three concepts that we look at from an insurance risk management. There's either you can avoid the risk, you can minimize the risk, or you can transfer the risk. And I just want to ask you, as a syndicator, somebody that's taken deals full circle from, we've talked all through it, from, putting the team together, raising the capital, managing the property, selling the property, and dealing with investors. What would
Yes.
you consider your biggest risk? And then, if you can, tell us a little bit about how you manage that, which you consider your biggest risk.
I would love to, love to, Darren. And the biggest thing I find is that the lender will not give the loan to me or any other principal unless we get the property fully insured. And that is, like, of course, for fire, vandalism, theft, loss of rents, and also flood insurance if something has happened around there, wind insurance, hurricane insurance, all that stuff. The other part is the cyber insurance, and then the director's insurance, that's called, where all my employees are really covered, because my property managers who are part of our company, they are dealing with the public and everybody. So if they do something error wise, they are taken care of. If some resident falls and things like that, medical bills come, or we have $10 million umbrella policies on each occurrence at each of our properties. And I really believe in over-insuring than under-insuring, to be truthful, and with less premiums, because less deductibles, sorry. Because the thing is, property is making good money. Why not to then pay good insurance money to really take averse the risk, I call it. The other thing I believe in is in key man's insurance. I pay $26,000 per year, which is coming due right now. And I took a key man insurance where my wife, who is part owner in me, she will get like millions of dollars tax free to run this company, which has built such a big portfolio. So that is a huge part also, which is called key man's insurance, because investors need to be protected. They want to make sure that what happens if Vinny dies tomorrow, accident or otherwise. So that's very, very important. Cyber insurance. I just took cyber insurance, by the way. I also took a couple of other insurance, my educational academy. I took my digital product insurance this year. So I've taken like 9 different insurances. I believe in that. So I'm so glad you asked me that question.
No, I appreciate you going on the insurance thing there, because that's, again, I want to stress and reiterate, insurance is one aspect of risk, and it's something we look at. But is there any other, like, just in the whole envelope of syndication, is there an area of risk that's, not necessarily with an insurance answer? Is there anything that you feel is a risk that you are constantly aware of, that you work to, deal with?
Okay, good point. I would say, the other risk I'm thinking again in the syndication world is SEC rules and regulations. By having a transparent operation, Daryl, that is the key. Making sure that we do the legal paperwork right. We have the investors accredited, non-accredited, or sophisticated investors to fill out the paper correctly. The other thing is to have pre-existing relationships. That's a huge. A lot of people are advertising without really keeping in mind what can it do if people looked into their operation. So I would say it's better to really be on a cautious side and make sure that when you're doing 506B that you have pre-existing relationships with the investors, and making sure that they are not spending every dime they own into your investment, because there are a lot of restrictions in that, and a lot of people somehow oversee that. The other thing I would like to say is that you want to have the interest of the investors' money foremost. Even if I lose my portion, and we have done it, by the way, in some properties, if the quarter did not go well, we wipe out our management fee, or we don't take our own investors, I know, our portion of the cash flow, but we want to give the investors their portion. So those things are very, very important. I don't know if what are the risks can be is, again, I'm on the loan on non-recourse and recourse debt, but the investors are never on the loan. So in syndication, of course, the most an investor can lose in a LLC. I don't believe in series LLC. I don't believe in land contracts. I only like limited liability corporations, so that one property does not hurt the other property.
Right, right. No, I appreciate you taking us through that. Like I said, it's something I'm trying to be more probing with my guests about, and I think that there's there's all sorts of risk, whether it be the interest rates we talked about, or just the market changing, or the price risk, or operating risk, and all that. And
Yes.
just trying to dig a little bit more in that with my guests, and I appreciate you giving us some of your insight on your view of risk. So I appreciate that.
Sure,
So,
Darren.
Vinny, before we wrap up, where can the listeners go if they'd like to learn more or connect with you?
Oh, thank you, Darren. Actually, it's very simple way to do now to reach my team and so forth. To just text the word, very simply. Word is syndication, because I'm the syndication expert. So syndication to 474747. Just like the aeroplane 747, we took the 7 out,
Yeah.
and 474747. Just text the word syndication, or they could also reach me through my website, vinneychopra.com. That's VINNEY Chopra.com. I have a multifamily academy group also. I think 861 members in there. It's an open group at this time. So, and I can teach. I mean, I'm really enjoying passionately my mastermind coaching sessions. And, it's like almost 90% lower cost or investment, I never say cost, than a lot of other people out, and so forth. So anybody can, come in, and we are actually now being very selective who joins our academy, because there are just so many people wanting to get in.
No, that's great. Vinny, I can't say thanks enough. I've always enjoyed our conversations, and as always, I learned a lot. And I look forward to doing it again soon.
Thank you, Darren. And I would love to even just come with you one day. I mean, on the call, talk about asset management, how we deal on a daily basis, how to bring those returns for the investors. That is a huge part missing. What we do at property takeover, what we do for the first 4 months, how we do on a weekly basis with the Monday morning reports, and how we do marketing, how we do leasing, how we do training, how the manuals are set up. I mean, it's a whole game. How to deal with contractors, vendors. That's my passion also now.
Well, mark my words, you and I will be talking about that soon. Okay.
Thank
So
you. Thank you.
we'll do that. All right.
Thank you again. And so glad, Darren, that we have been friends, and what a great value you're bringing. I want to really congratulate you for what you have brought into your audience. And I hope that, a lot of people are getting a lot of great value. I listen to your podcasts, and credit goes to you and your team.
All right. Well, Vinny, I appreciate all the kind words, and we will be talking again soon.
Okay. Thank you.
All right. And for our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.